Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of the investment firm Wilsey Asset Management. Thank you for joining us today. We've got a great show lined up for you. A lot of good things to talk about, a lot of good companies to look at. We're going to kick off the show, and a lot of talk about the dollar. Oh, things are terrible and so forth. Well, has it become too weak? We'll discuss that, make you a smarter investor after we're done. And with that, you'll understand maybe it's not as bad as people say it is. 18% of U.S. adults have taken GLP-1 drugs. What's a concern? We'll tell you what the concern is and why, investment-wise, Eli Lilly may not be the one to go with. And then also in the U.S. housing market, well, it looks like it is becoming a buyer's market. It's been a seller's market for quite a while. Looks like it's kind of flipping there. We'll talk about those numbers there. And Chase, what companies are we covering today?
Today we're going to look at Cisco, and not the tech company, the food company, the food distribution company, and the name Cisco. Also, we're going to look at Microsoft. They've been not doing well, to say the least, so far year to date. We'll also look at Visa. And lastly, speaking of housing, we're going to take a closer look at home builder Lennar. As always, break down the fundamentals, giving you an idea if we think it's a buy, hold, sell based off the numbers we see here.
So let's kick off with has the dollar become too weak? And I hear people saying, oh, this is terrible. Oh, the dollar, we're going to have all kinds of problems. They just don't look long enough, and they don't understand what's going on. And it can be difficult to filter through the headlines that make up it appear the dollar's dropped, and people say, oh my gosh, it's down 50% of its value, and it's getting close to collapse, as some doom and gloom people, they're always out there, would want you to believe. The truth is, since January 2025, the dollar is down about 10% against other major currencies. Now, keep in mind, it does fluctuate every day, every hour, and actually every minute. So don't worry about these things that people are saying. We're going to give you more reasons why not to worry about it.
And I'm going to go even one step further. Every second.
Every second. There
It's
we go.
going all the time. It's always that fluctuation. Again, this is normal to see fluctuation. It's not like this is crazy. We've never seen this before. But the headlines, they can be so scary. And it's important to understand when you look at the long term. I bet you a lot of people don't know this. The last 5 years, the dollar index is actually up about 7%.
No, that can't be. That's not what people think. They think it's down for forever.
Yeah.
Up,
and it's
up,
like,
how
wow,
much?
7%. Again, it's not booming, but realistically, you're not going to have that go up 50%.
That's not Bitcoin.
Exactly.
Yeah. Which is another thing, down about 50% on Bitcoin almost.
You did actually go from peak to valley. Yeah, it was down more than 50% for
Wow.
Bitcoin. But again, dollar, generally currencies are going to be more stable. And obviously, you compare one currency against another, there's going to be more volatility there. But in a basket of currencies, unlikely to see major moves. And again, to still be up 7%, it's, again, not as big of a problem as the media is making out to be, in my opinion. Now, there are pros and cons to a weak dollar. If you're planning on traveling to Europe or some other foreign country, hotels and other items, well, those will cost you more when the dollar weakens, since our dollar buys less. Thankfully, I'm not really looking at traveling right now. Yeah. I was a big Europe guy when I went over there a couple of years ago. But also, too, the price of foreign cars and trucks, well, those will increase because, again, a dollar buys less. So that's good for us. We like General Motors here, so we like the U.S.-based companies.
And the other side of the coin is that people from other parts of the world can now come to the United States and spend money in our economy, since our currency now goes much further for them. Also, many other products of our products that we export will be less expensive. So exports should increase while our imports decrease. And what this does, it reduces our trade deficit, which has been a problem for years. Lower interest rates can cause our dollar to fall, but a strong economy can help counterbalance that decline. And Chase, heard people saying, oh, no one's coming here to the U.S. because how they feel about us. It's wintertime. It's not a big travel time. I think when we see May, June come around, I think you'll see a lot of people taking advantage of, like, wow, we can see Disneyland, we can see Disney World, all these things.
Yeah, and I am going to say I did look at 2025 for the full year.
Right.
It wasn't a good travel year for international travelers, and you can say what you want. Maybe it was politics. People don't like Trump, sure, whatever. I don't think that lasts forever, right? Yeah. Oh, people get all fired up, every time. Not every time. it's happened twice now, but when Trump is one of the, I'm leaving the country, and the people don't leave. I think it's the same thing. People are going to be very emotional maybe in year one, but as time progresses, you kind of care less and less. Kind of like the same thing with boycotts, right? When everybody's going to boycott Nike or boycott the NFL, you know, I think there's been other major boycotts. They last for like a month and they dissipate. I would not be surprised if international travel returns as people start kind of being so emotional about it.
And I think you're right. And I think what's going to happen is people say, I want to go see things in the United States. And okay, I don't like the president over there, but I want to see the Grand Canyon. I want to see
New York City.
New York City. I mean, I want to go to Hollywood. I mean, all these different things that we have. We're a great destination to travel to. I think you're right that eventually people say, okay, again, I don't like the president, but I want to see this before I die.
Yeah, exactly. And kind of to that point, you know, will there be a default on the dollar? I mean, the chances of that happening are just extremely low for many reasons. The U.S. dollar is still the dominant global reserve currency, which adds strength to the dollar. Now, that has been, I'm going to say, lightning, again, a little bit. We have seen the decline in the dollar, but again, it hasn't fallen off a cliff. And it is also understood that, yes, we do have high debt, but also, if needed, the U.S. can print dollars to pay down that debt. Now, that's a whole different debate if that makes sense or not, and is it inflationary, and you know, a lot of kind of conversation can be held around that. But we do have the taxing authority of the U.S. government with, you know, U.S. business. You have U.S. consumers, which are very healthy. So again, you have an economy that is very healthy that can, right or wrong, be taxed to help pay for that debt.
You know, and when you think about it, because when I was looking at this, you know, what would happen if the U.S. was not the global reserve currency? Who's going to step in? You know, I mean, we have the strongest economy. We have the best taxing power. I mean, it'd be a disaster for the entire world if that were to happen.
You can't trust China. You can't trust, you know.
Let's do Russia.
Europe, I would say. Europe. I mean, the euro is.
I think it was in the 90s. I think her name was Heidi Flight or something. She was a model. And she says, I'm selling all my dollars and getting euros. That was a disastrous thing that happened. And that's when the euro was much stronger than the dollar. Well, that again didn't last very long. So, but looking forward in 2026, there's a good chance, a very good chance, that the dollar will stabilize as our economy improves. Now, keep this in mind. Foreign top trading partners have pledged to invest $5 trillion in the United States. With that large investment, more travel to the U.S., and people buying more U.S. products such as cars that are now a better deal due to tariffs and a weaker dollar, come the end of the year, we could actually see a firmer dollar and a booming economy, which will push up the dollar.
Yeah, I don't know if I'll call it booming, but I think we'll still see a good economy. And I think I mean, booming is so hard to get to, right? You're talking about 5% GDP growth. I don't see that happening, but
I think
if you have a good economy around 3%.
Yeah, I think we could have that. I mean, there's so many things going on in 2026. I mean, I think we could have a booming economy. Maybe Trump is talking to me in my ear. I don't know, but
maybe I think I'm optimistic, but less optimistic.
Okay.
I'm still looking for. I'm not looking for a decline. I'm not looking obviously for any recessionary signals. I still think we'll see somewhere around maybe 3% growth. I'd be very happy. I mean, 3% growth in GDP that's a good economy.
I don't know. I'm gonna say November, December. You can say, "Gosh, Brent, you were right. It was a boom economy."
I guess we'll find out.
We will
but
see.
The thing that you look at, if we have that boom, or even if we have a good economy and that dollar does stabilize, this could point to further declines in gold and silver that even with the massive pullbacks that we've seen, particularly in silver, they are still near all-time highs. I mean, they are still, it's kind of funny I say expensive, but there's no real way to value gold and silver. You can't value the earnings, value the cash flow. Again, we don't buy precious metals because there's no way to value it. It's only worth what the next person will pay for it. But again, if there is that stability, there's the economy is looking better, the dollar stabilizes. You know, that's the whole concept, right? It's called the debasement trade, where people are going to stop using the dollar. I think that's an emotional trade, and I think that emotional trade will run out eventually, which is why don't get used to having gold go up 70% and silver going up 200% a year. That's not likely, I think, to repeat itself in 2026. I would not be surprised if gold and silver actually end negative on the year in 2026.
I would not surprise me either. And I don't know if you know, but how much, you know, because I don't follow silver. I think it was down quite a bit. Do you have that number or no?
Yeah, I mean, I can find it real quick. I have like CNBC pulled up, so it always gives me that, like just today or since the peak.
Oh, since the peak. I mean, because everybody's so excited. What was the peak? Was what, 125?
Looks like it currently is around 77.
Oh.
Yeah, and the
Didn't it
oh, it
peak
doesn't,
at
oh 52 week. The high was 121.
121? So
Yeah.
so 121 to 70. That's
77. Yeah.
77. Okay, we'll say 80. That's still what, a 33% drop.
I mean, the crazy thing is the 3-month return on silver still 62%.
yeah.
I mean,
Well,
it's nuts how much that went up. So again, don't be surprised if
yeah.
you see something similar that we've seen with Bitcoin and cryptocurrency.
Yeah, things are changing, so be careful if you speculate on silver, gold, and Bitcoin. But is the U.S. housing market, well, is it becoming a buyer's market? Well, from 2020 to 2022, it was definitely a seller's market, and people could ask pretty much whatever they wanted for their home. And if you didn't take it, well, guess what? There would be 10 people behind you that would take that home. Well, now things are changing back to where buyers can actually negotiate and sometimes even get a price below the asking price. Now, nationwide, about 62% of home buyers purchase their home under the listing price. And the discount of that under the list price was 8%. That was the largest discount since 2012.
That really shocked me because, again, during the post-COVID era, we'll call it that short time period, the list price was $1 million and that thing would go for 1.2 million.
I know.
It's just like, whoa.
And people
Just
see
kept
it sight
going,
unseen.
and
It was
like-
crazy.
And you just had the bidding wars, and they
Yeah.
were gnarly, where you'd have people out of the state. It seemed like, yeah, I've never saw it. Yeah, I'll give you this, and it's like, what the heck? So again, things have I don't think gotten necessarily more inexpensive, obviously, but they're starting to normalize outside of the crazy times that we saw. And kind of speaking to that point, buyers are also obtaining concessions from sellers, which could be things like cash for closing costs or buying down the mortgage. We've talked about that before. If you get cash, don't buy down the mortgage at these interest rates. It many times is not the right thing. Could be depending on your situation, but many times I don't think the math checks out. Maybe check with a good financial planner like ours, Harrison
Right.
Johnson, before you look at that. As recently as December, though, there were 600,000 more sellers than buyers, and that's the biggest gap going back to 2013. So again, we have 2012, 2013. I mean, we're talking about 13, 14 years that we've seen a housing market with some of these conditions. What is helping the housing market, though, is mortgage rates have declined a little bit, which has made homes somewhat more affordable for some buyers, along with the cool-off in prices that we have seen. And again, it's not like prices have declined substantially. In some areas they have, but I mean, you had a time period where home prices were going up 15, 20% in like a year, and now we're not having that. We're having a more normalized housing market.
And unfortunately, there's people that bought those houses at the peak thinking, oh, wow, I'm going to make all this money. And again, you never should buy high. It always hurts you, whether it's stocks, real estate, commodities. I mean, you have to realize what you're paying for something. But also, too, these are nationwide numbers. You may say, well, no, my house next door, they sold this and so forth. This is a nationwide number, an average. But the best place to buy a home currently is in Florida and Texas because new home construction has created a big supply of homes for sale. And again, higher supply, lower demand will lower the prices. It can really depend on the local market you're looking at, but if you're buying in West Palm Beach, Florida, Fort Lauderdale, or Miami, about 85% of home buyers paid under the original listing price. However, if you're buying a home in Newark, New Jersey, San Francisco, or San Jose, well, only 39% received a discount from the original list price. So understand where you live and the local market can make a big difference. But we look at nationwide because of that deals with the economy, investing, and everything else.
Yeah, and when you point out those ones that you're not getting the same type of, I'll call it, deal, it was also noted that those markets, no surprise here, had a low amount of new construction. And I hate to say it, but if you notice the locations of them, generally going to be more regulations. So, you look here in California, our regulatory costs in building a home is one reason that our expenses to buy a home is so much greater because it is so cost prohibitive with all the rules, the regulations, the difficulty and the speed of the process of building a home. So, I mean, it doesn't really surprise me that we're still seeing that difficulty there. And the thing I like to point out for people is there could be more to come if the supply increases. We've talked about this a lot. And then prices ease somewhat, as it would likely bring more buyers back into the market. Depending on where you're looking at buying, perhaps 2027 will be a great time to buy a home. I wouldn't be surprised if we see a slight decline in home prices year over year this year. I'm still not looking for a major collapse or anything. Obviously, the economy is too strong. Consumers are too strong. housing prices pull back, I think that'll then bring buyers back in. So you're going to have a floor on how much prices could actually decline.
And you said it'll bring buyers back in. You said decline or an increase?
If prices decline?
Decline.
Yeah, prices decline, then buyers would come back in, and then
yeah.
it create that
Right.
floor in the market.
And what I think that'll also do is show people that want to sell their home, like, I guess it's the time to sell it. So people get tired of waiting. And again, 600,000 more, was it more buyers and sellers? No,
other way around.
More sellers and buyers. And that's so important because that means like, and people, especially you have this feeling back when the market was hot, you could sell your house in 10 days. Now you're going to wait 2 months, 3 months. I better cut the price. I need to get out of here.
Yeah. And there's going to be some people, the 600,000 surplus, that might decline as we look forward because those people might be thinking it's like what we had before and they're looking for a quick turn or a great profit. And if they don't get that number, they might not sell. But there are other people in that 600,000 that they need to sell. Maybe they can't afford it anymore. Maybe they want to downsize. Maybe they need to move for a different job and they can't handle 2 mortgages. I mean, there is going to need to be housing turnover to some degree.
Right.
It's of those 600,000, not all of them have the luxury of maybe not needing to sell.
Yeah, and it's just an important thing to look at. And again, be patient. That's what we're saying, 2027. You might get a great deal in 2026, but again, I would not be in a hurry. And I just still worry about interest rates because of all the debt. But these are things you have to kind of look at. But let's talk about 18% of U.S. adults have taken GLP-1 drugs. What's a concern? Well, I thought about this because I always look at what people are doing. And Eli Lilly, their stock is on fire. They're doing so great. But you got to get the diet drug companies because they're doing so well. We spend 15, 20 hours of research before we get into things. So I want to share some of the research on these companies so you understand, wait a minute, there's more to it than just buying, quote unquote, a hot stock. Now, the price of GLP-1 drugs have come down, which means less profits now, I'm just realizing as well. But in roughly 18% of adults in the U.S. are now using them. But there are other considerations outside of just weight loss. These drugs come out to treat type 2 diabetes and obesity, not as a lifestyle change to lose 20 or 30 pounds. It is estimated that about half of the people who stop taking the drug after 1 year will probably be very disappointed with their future weight management.
I don't mean this as a dig, but might come off that way. I don't personally know anybody that is taking the GLP-1s as a lifestyle change. But again, 18%, that's 1 in 5 people almost. And
I do.
Okay. I was going to say, I wonder how many
You're
people...
younger, maybe.
I am, but I'm going to say, I wonder how many people would admit to it, or if they want to kind of pat themselves on the back and say, it's my workout plan, my diet, I'm working hard at it. I'm curious, of those 18%, how many actually admit to being on the GLP-1s? And again, I know we have clients, I know people that are taking them or did take them for the diabetes reason, but again, I don't know about the lifestyle change. So.
And there's problems we'll talk about at the end why you shouldn't be doing it.
Kind of to that point, studies have shown that when people stop taking the drug within about 1.5 years, they regain most of the weight they lost. Studies also show that the weight gain comes 4 times faster than those who lost weight through normal dieting. While on these drugs, people see their blood pressure, cholesterol, and blood glucose levels improved, but when they're off the drug in a little over 1 year, well, those levels, they go back to where they were.
Yeah, and there's so many factors with that because it just, you're off the drug, and I guess it curbs your appetite. So when you have no curb there, you're just kind of, I'm hungry, I got to eat, and you eat, and you eat, and you eat more than you did before, is a problem. And Kevin Hall, he's a former senior investigator with the National Institute of Health, and he's also a specialist in nutrition. He says, once you're off the drugs, your appetite will be much higher than it was, and you could even end up overeating, which leads to taking in too many calories. Another study shows people who gain the weight back and decide to go back on the medication. This I did not know. This was surprising to me, that it's not as successful the second, third, or even the fourth time around. Each time you go off it and then you get back on it, it's not going to be successful. I don't know if your body becomes adapt to it or immune to it or whatever, but it doesn't work as good the second, third time you go back on it.
Yeah, I mean, that was kind of surprising to me, I guess. But the thing I look at is with these drugs, and this is the thing that kind of scares me, right? Is you said it curbs your appetite. Well, it's doing something to your brain chemistry to do that. And I'm not a doctor. I'm not going to sit here and pretend like I know what's going on with it.
But we are analysts, so we analyze data is what we do.
But not even the data side.
Right.
I'm just saying logically, like that concerns me a little bit, right? Like what is it doing to your brain? It's switching off some type of receptor that is maybe curbing your desire for food, your excitement around food. Is it also long-term going to have other issues on your brain chemistry? I don't know, not a doctor, so not really an analytical point of view either on the number side. This is kind of a thought that I have with these drugs is they are still relatively new, and people maybe that have been taking them for years that have diabetes or other concerns. Correct me if I'm wrong. I don't know. It's just something that I do worry about, I guess, if I was on this drug.
Oh, yeah. Yep.
Another thing, too, is people don't realize a thing called weight cycling or gaining and losing weight and how that can affect the percent of fat to muscle. It is estimated that when you lose weight, about 25 to 30% of it is muscle. But the sad part is when you have the weight gain after you're off the drugs, it is unfortunately more fat than muscle. So as you can see, this is not a good cycle or a good plan for 10 to 20 years. If one thinks it is a good idea just to stay on these drugs for life, again, outside of maybe the long-term risk I just brought up, there are other long-term risks such as gallbladder diseases, pancreatitis, and kidney damage.
And that's one that worries me because kidney damage is one that would really, again, I said worries me because as you get older, you have more pain and you want to relieve that pain by taking like Advil or ibuprofen. But doctors now, and I do this like with a doctor, they check your kidneys to see if you can handle it because, your kidneys aren't functioning well. Then you got to suffer with the pain, and these drugs can hurt that. So you want to be careful of that, which, again, you don't want all these strain on your kidneys. And being concerned about how you look and taking the easy way out to look better by popping a pill or taking an injection may cause you to have regrets, as I said, when you're older, because I'll tell you, I won't tell you how old I am, but it's like you do start having pain. Like, gosh, you get up in the morning like, ow, that hurts.
Yeah, I just always kind of view it, right, as when you do it for a year or two, you didn't really change your lifestyle, right? You popped a pill. So it almost has to be a long-term thing because you're not just going to all of a sudden take the pill and then one day wake up and be like, I am going to go to the gym 4 days a week. I am going to only eat vegetables and meat and eat healthy and change my lifestyle. Being on that drug doesn't change that for you. So the moment you pop off of it, if you didn't make the changes, you're not going to keep the weight off. So it has to be a long-term thing, which raises concern about that. And, they keep talking about how big the market is for this space. And I got to say, I remain skeptical, right? Yeah. I mean, 5-10 years from now, how large is this market actually going to be? I'm not sure. We'll have to find out.
And again, you brought up the point about the weight cycling. I don't think people realize that, and it's going to be very disappointing on their second, third trip around because, and the expenses, and I really question, should the insurance companies be paying this? I mean, we pay so much for insurance. People complain about insurance going up. Well, if everybody's taking these because they need to lose 20, 30 pounds, and the insurance companies have to pay for it, health insurance companies have to pay for it, that's a problem. I mean, that was not fixed into it. And then, well, my health insurance premium is so high. Yeah, because everybody's abusing the system. It should be for health, not for weight management. But and I do worry about competition for Eli Lilly coming up from other companies because everybody's trying to get the hot drug pill.
I mean, and we know that Pfizer, they just bought Metsera for $10 billion. We know, obviously, Novo Nordisk is the other major player currently. I think there's also one called like Viking Therapeutics or something that has a decent one. Yeah, I mean, it is something you have to be aware of if you hold Lilly because I think that is obviously the big reason they are, I believe now, the most valuable pharma company.
I believe you're right. So let's change from drugs to real estate. Let's talk about Lennar, which is a home builder. Their symbol is L-E-N, Len. What the guy who owns it, his name Len? Lenny, maybe. Probably not.
I doubt it.
Do I have the right? No, I'm looking the wrong one here because I'm looking at, let me look at Lennar. I was looking at something else in the future here. But they are in residential construction, short on the float size, about 5.5%, 99% institutional owned. So a lot of people don't hold the stock individually. We do see a PE ratio of 14.3. That's above the industry at 13.9. Price to sales 0.9 versus 1. Price to book value 1.3 versus 1.4. And price of cash flow, very expensive. I think because it's real estate, 135 versus 20 for the industry. So something strange there. They don't have much cash flow, and I think because of the way they do things, they may carry the mortgages or something of that nature.
And they carry on such heavy cash flow when they sell, but then when they're building, obviously that's very cash intensive.
Yeah, again, understand the business. PEG ratio going forward, 2.6. The industry is at 1, so that's not very good. Earnings per share over the last year, wow, they were down 44.2%. The whole industry was down 15.8%. Sales for Lennar did close down about 3.5%. The industry down 8.5%. So we know the home builders are kind of struggling a little bit here. And again, a lot of it's the expenses. You talked earlier about the expenses of from the cities and the counties. They're just tacking on all these permit fees and everything else. And builders say it is so hard. I think I heard a number like 20% of fees of the house goes to fees and the permit process and everything else.
Could be wrong. I think here in San Diego or in California, I think it's 25, 30%. I think it's a huge amount here.
Huge amount, yeah. It's a shame it goes, to the city and the county. So, a 5-year earnings per share growth on Lennar is from the analysts is a 7.6%. That's on the earnings, above the industry at 5.7. They do pay a 1.8% dividend. They use about 25% of their earnings to pay that out. Look at the balance sheet. Current ratio 10.7 versus 7.4. Again, that's that liquidity of how, since they're a builder. Debt to equity is pretty low, 0.3 versus 0.4. Net profit margin, pretty decent, 6.1, below the industry at 7.8. And we do see return on equity is 9.4 versus 13.4. Cash flow, free cash flow for them is $28 million versus $1 billion for the industry. So we know there's problems, but could this be unique to Lennar that they're having problems?
Yeah, it could be. And I did ChatGPT it real quick just to see. And again, ChatGPT, so not a ton of research here, but this says, when I asked it how much of housing prices comes from permitting and regulatory costs in San Diego, this is around 40%.
Oh, geez.
That's pretty crazy.
And you think we'd have better streets with no potholes and everything be perfect. Where's all that money going?
I don't know. But I got to give the numbers here real quick for Lennar. The current price here, $114.02. 52-week range low, $98.42. And the high, $144.24. Going forward for this company, go out to November 2027. They do report on a fiscal year basis. Estimated earnings per share, $8.82, gives us a target sell of $146.41. So forward multiple, there's about 13 times, a little bit above where we would like to initially buy a company. And this company, we wanted to look at it because there's been this kind of push to calling it the Trump home. It looks like a White House official came out and said the administration is not actively considering the plan. So this is something maybe the housing builders, the home builders came up with. Concept is kind of more of a build to rent to own for people. Is that going to come to fruition? I don't know, but if that increased the demand for homes, could be good for the home builders.
Yeah. All right, we'll see. First half went by pretty quick. When we come back, we've got Harrison Johnson, our CFP. Also, too, all this information does come on our website. Go to the website, smartinvesting2000.com. We'll be right back. All righty. Welcome back to the Smart Investing Show. And it's time we talk to our financial planner, our Harrison Johnson, our CFP here at Wilsey Asset Management. Harrison, thanks for being here today.
Always.
I saw your topic. How would an S&P 500 portfolio work in retirement? I have my feelings, but I want to see what you say because I know you do the retirement planning for people and so forth. So is this a good thing or a bad thing?
Well, I guess it depends when you retire and what the S&P does, like with any investment. But the reason why I bring it up is because, there's people out there that they had their 401k invested in the S&P, and now they're going into retirement, and they look at the last couple years, and, oh, my 401k has done pretty well. I think I'll just I'll stay with that. So I have a parallel to look at the 90s because a lot of people did the same thing in the 90s. If you look at the return of the S&P, from 91 to the start of 2000, it was positive every single year.
Oh, wow.
And from 95 through 2000, so that last 5 years of the 90s, the average return of the S&P was about 30% a year annualized.
The last 5 years. That's a tech boom.
So I mean, if you're retiring, if you were somebody who retired right around 2000, look at the S&P. Wow, investing's really easy. You just the money just goes up every single year. So it's as easy as that. So if, for example, and I thought about this, my dog woke me up the other night, and so I couldn't get back to sleep. So
and you got a big dog, don't you?
Well, that's why.
Two big dogs.
He's big.
Two big dogs.
It's like 2:00 in the morning. I'm just thinking about this because I can't go back to sleep. So if you're somebody who retired in 2000 and you looked at the 90s and wow, everything's so great, so easy, I'll just keep invested and I should be able to withdraw money and continue to make a lot of money in retirement. If you started with a very conservative withdrawal rate of 4% of a portfolio that's in the S&P, if you retired in 2000, within 3 years, half your money was gone.
So you lost 50%.
You lost 50%. Wow. So that's like if you retired at 62, by 65, half your money's gone. If you maintained that plan, so you kept your discipline and you stuck through it and you continued to withdraw money, and again, this was starting with a 4%, conservative withdrawal rate. 9 years into retirement, so by the time you're 71, now this is 2009, 2/3 of your money is gone.
Holy crap. I was going to say something else, but I don't cuss on it.
And at that point, if you wanted to maintain the same dollar amount that your withdrawal is, you're now not at 4%, you're at a 14% withdrawal rate from that portfolio to maintain that level. So you retire at 62, by 71, 2/3 your money is withdrawn, and you're withdrawing now 14% to keep up. It's not sustainable. So, we're seeing something similar right now where the S&P has done well, but really a lot of things have done well. Mm-hmm. So, when everything is going up, a lot of things just go up. But retirement lasts, 20 to 30 years. And if you look back, from where we are now, in the last 30 years, we've had 4 bear markets. So that's a correction of over 20%. And we've had, or that's a pullback of over 20%. And we've had 20 corrections. So that's a pullback of at least 10% in the last 30-year span. So people are retiring now. You're going to go through hard things. And so you need to be aware of that. And just because, a certain investment strategy has done well, maybe that's not because of that investment strategy necessarily. That's because everything did well. And, you look at the S&P, the average return of the S&P over history is about 10% a year, but that kind of can be misleading because if that average is 10%, but if you start withdrawing going into a down market or you're withdrawing as you go through that, in many cases you deplete that portfolio more than it can realistically recover. So when you're looking at retiring, you really need to be careful of, yes, you want to make money. We're not talking about selling annuities or being so conservative that you don't make money anymore, but you need to be realistic on what really can happen with a portfolio like that.
And I think people don't realize when you go down 50% or 66%, I think you said, you cannot recover because you're taking on the same distribution, you're taking more of the portfolio. This is why in our income program, we look at it very closely. I tell people, be careful about taking out too much. We watch it very closely. And we've done ours for now 26 years. Our distribution rate is 6% because of the way we manage it.
Yeah, and that can be done, but it's definitely not easy. And so when the market is going up, it feels very easy. But to maintain a withdrawal rate of 6% through, a 30-year span, that's hard. Right. It's great when, the market goes up 20%. Oh, we only withdrew 6, so the portfolio grew. Well, what happens when you go through a period where it's down and you are also withdrawing? To your point, Brent, if you lose 50%, what do you need to get back to even? It's not 50. Now you need 100% to get back to even. So the more you lose, and if you're withdrawing during that period, it makes it harder and harder to come back. So even though that, the S&P might eventually come back, your portfolio might not because you were also withdrawing during that down period.
A couple of thoughts that I have for people. Number one, you did mention over the last 100 years, the S&P 500, the average annual return is about 10%. But the thing I look at is over the last 15 years, it's averaged 14% per year. So, just kind of mathematically speaking, if we have a reversion to the mean of 10%, we're talking about maybe a 6% gain per year. I don't know how the compounding works out, but just simple numbers. The other thing that I look at, just kind of looked at, what happens with the average annualized 10-year return when the CAPE ratio, which is something that we look at, the cyclically adjusted PE ratio, is over 20, which we are there now. Historically, it's a 6% annualized return when the CAPE is 20 to 25. We are also above the CAPE of being 25. Historically, when we've hit this, the average annualized return over the next 10-year period is about 3 to 4% per year.
So that's where you get to a point where if you don't have the growth, because I mean the dividend yield of the S&P 500 is like 1.2% right now, maybe, depending on which fund you're in. So that means you need to be selling. And if you're selling at the wrong time to keep up with the withdrawals that you need for income, you're potentially not coming back from that.
Yeah, it's such a mistake that people make. They just look at the history. Oh, well, I can retire on this. They don't understand cash flow. They don't understand volatility. They don't understand overpaying for things. And that's why our income program works very well. But you're right. There's probably people like, oh, I've done so well in my IRA, my S&P 500. I think I'll retire and just take income from it. They don't get there's not the big cash flow.
And again, we've talked about this before, but it just blows my mind. The CAPE ratio right now is around 40. The historical average is around 16 to 17. So that's why, again, your future potential is not
People don't know
nearly
what
as good.
CAPE is. What does CAPE stand for?
Cyclically adjusted PE ratio. So again, it looks at the last 10 years of earnings on an inflation-adjusted basis. And, it's historically been a pretty good indicator of forward returns, and doesn't mean it's right every single year over like a 1-year time period, but generally over decades, it can kind of help with where we're at valuation-wise. And again, people just miss the fact, again, we've made about 14% per year. You're not going to have the same type of multiple expansion that we had over the last 15 years. So now it is all relying on earnings growth, which I don't think we're going to have the same type of earnings growth. Plus, then you don't have the multiple expansion, maybe multiple contraction. That's where you lead to a S&P return over the next decade of maybe 3 to 5%.
So Harrison, somebody comes in, they've got 90% of their assets in the S&P 500 fund. Have you had that happen before?
I have. Yeah. And so that's why, I brought it up because, whether it's somebody who retired and they were a government employee and they were in the TSP and they just had everything in the C fund. I don't think people are really aware of the risk that they're taking with that type of investment while they're also withdrawing from it. Now, there's some people out there that their income is fully covered by Social Security and pensions, and so their investable assets are, in whatever they are, but they're not really withdrawing from it. They don't have the same type of risk. You still want to make money, I would say. Oh, well, I don't care if I lose it. Okay, well.
Said no one ever until you actually
say that
do.
now when it's at a high point. When you lose half of it, you're not happy. So I mean, it's something that you can tell somebody, but a lot of times, we can talk about the math and the valuations and the numbers and history and everything, but until someone goes through it, a lot of times they don't want to listen. Yeah, I hear you, but I'm just going to continue to do it. Okay.
Yesterday we met with a client and we asked certain questions on a questionnaire before they come in. And one of those we ask is, what is your worst investment? And we never got this before. I've been doing this for 40 years. He goes, my worst investment was not hiring a financial advisor.
Not seeking advice sooner is exactly
That's
what
it
he
was.
said.
Right, exact words. So your memory's better than mine, but I got the concept.
Yeah.
Yeah. People tell me all the time that they wish they had met me sooner. I mean, I get that a lot.
Well, that's why they need to call you now.
Yeah.
Well, Harrison, thank you very much. We appreciate it, and we'll talk to you more on Monday.
Thanks, guys.
All right, again, that's Harrison Johnson. He is our CFP, our financial planner at Wilsey Asset Management. As he said, people always say, I wish I had met you sooner. Don't be the one that delays and wait. Give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. He is a fee-based planner. He's not going to try to sell you annuities, and that's why people say, gosh, wish I had met you before.
Yeah, and I did want to have one more comment about his topic today was, past performance is no guarantee of future results, but past performance is generally how people make their investment decisions. And that is why I think people are potentially setting themselves up for failure here. Because, again, the S&P has done great. And we've been saying now for years it's expensive. But the problem is it keeps getting more expensive rather than actually coming back more into historical standards. So, I don't know, 5-10 years from now, it could still be wrong, but you have to make the best estimate you can with the facts that you're given. And right now, the S&P, it's expensive.
Yeah, and I try to tell people, don't look at the past performance, as you said. Look at the concept of investing. That's the important part, how you invest during good times and bad times, how you're going to handle that. Not just, the return was, 14% the last 10 years, so that must be good. No, that could be terrible because everything could be very high, and now next 10 years. And I think that 10-year return on the S&P 500, I think you said, I agree, around 6%.
3 to 5, yeah. That could be a very realistic possibility there. And, I mean, we'll see what happens. But, the thing we kind of looked at last week, we did the software stocks, and, you had a great 5-year return, but then your next 5 years were terrible. I mean, it could be something similar with the S&P here when we're talking in maybe 2031.
Yeah. Well, we'll see. All right. Well, let's look at another company here. Looks like at a food company, Cisco, and that's the food company that starts with an S, not the tech company. Their symbol is SYY. They're in the food distribution area. Float on the short side is only 3.1, 90% institutional owned. PE ratio 23.3, pretty high, but so is the industry at 26.4. Price of sales 0.5 versus 0.3. Price of book value very high, 18.2 versus 3.5. And price of cash flow, unfortunately, no sale here, 16 versus 11. And you do want the evaluation numbers to be lower than the industry. And also the PEG ratio, though, does look good, though. And this is price earnings divided by growth, what you're paying for the future growth, 2.4 versus 9.8. Now, the earnings of last year, they are down 4.9%. The industry down 3% or 0.3%. Sales for Cisco were up 2.6% versus 7.3%, and the 5-year earnings per share growth estimate for the analysts 7.5% for Cisco and the food company versus the industry at 10.2%. Now they pay I'll say a decent dividend at 2.5%. They use 57% of their earnings to pay that out, so that's pretty reasonable. We do see on the balance sheet we've got a current ratio here 1.3, same as the industry. That's pretty good. Concerning on the debt to equity, it's 6.6 versus 3.2, and I don't know why that'd be so high. They're just a food company. Well, there's no franchising. There's no banking. I don't know. That's something you got to look at. Yeah, it's very, very odd. The industry is at 3.2, which is also high. So there may be something we're missing there. And again, these are the reasons why it takes 15, 20 hours to look at companies, because there's so many things you got to look at. You can't just ignore it and move on. You've got to understand what you're investing in. We do see the net profit margin is 2.2% versus 1.2%. I think they have very low equity, because return on equity is 78.8 versus 29.9. And then what you want to do is, well, why do they have such low equity? May have a lot of debt or something. So you got to understand that as well. Free cash flow, $1.7 billion versus $1.1 billion for the industry. So that's a positive. Chase, what do you got?
Yeah, I was just kind of digging through some stuff here. I was curious on the business. So, I mean, obviously we know they distribute food, but it also looks like they do supplies like paper products, disposable napkins, plates, cups, tableware consisting of glassware and silverware. So, I mean, they seem to do a lot of distribution really for the restaurant industry. And I was curious, about, it looks like 60-ish% of the business comes from restaurants, but they also have the industries of education and government. So they supply food, it looks like, for colleges and other government entities, and then also healthcare. So I guess they're giving food to hospitals. And then travel and leisure. So kind of same boat in my mind as restaurants. But I was thinking this would be an interesting one because the economy has been so strong in terms of restaurant spending. I was like, hey, this is kind of an indirect play on restaurant spending.
Yeah.
But, disappointed by the debt, and I'm kind of giving a little bit of the secret away here, but kind of disappointed by the numbers going forward as well. I will start with the current price, though, at $86.53. It is near its 52-week high, as that did hit that on Friday, actually, of $86.72. 52-week low, $67.12. The stock's been a good performer, up 21% over the last year. Over the last 5 years, it is up 12%, so not great there. And then over the last 10 years, you've doubled your money, up 100.25%. Going forward, though, this is where my disappointment lies. June 2027, estimated earnings per share of $5.09 gives us a target sell price at $84.49. And you're not getting much growth here. This year, estimated earnings are expected to climb by about 3%, and next year about 11%. So, I mean, you kind of look at that over a 2-year period. I mean, you're talking about 7-ish% earnings growth compounded. I mean, it's really not that exciting of an earnings growth rate, and the multiple's not, I'm going to say, super attractive.
Yeah, and I did look at the balance sheet. They do have a lot of debt in the balance sheet, $11.4 billion. And I will say that's down somewhat from March of last year. It was about $12.9 billion. But what it is, they've got assets of, let me see where the total assets go. The total assets were $23.2 billion. So if you've got liabilities of $21.1 billion, that's only equity of $2.1 billion. So they do have a debt problem. I'm not sure why, being a food distributor. I mean, you got to have the trucks, I guess the warehouses, maybe freezers.
Maybe they rent everything. I don't know. That'd be kind of odd. I would assume you want on some of those assets.
Yeah, so I'm disappointed because I generally like simple businesses, but this one here, it could be bad management, just has too much debt, made bad decisions. I don't know, but I'm disappointed. I was hoping to find one that was a yes.
Yeah, me too.
Yep. Well, I guess we're going to cross that off the list, so that's gone.
That one's done.
Shall we move to, let's go to the smaller company called Microsoft, which is, been having some, I think they were a high of 550. I mean, I think
555.
Wow. And I think on Friday they did close back above 400 or no?
401.
401. But they did, I think they were down like 380 or 390 or something this past
I
week.
think I saw it was like 393 or something. Oh, actually, the Friday day range, the low is 392.
Oh, okay. Well, let's see if it's a buy, sell, or hold here. We're talking about Microsoft. Their symbol's MSFT, the software infrastructure. Shares float very low, 0.7%. 76% institutional owned. So it means about 24% of people actually hold the stock themselves. PE ratio, 25.1. That's not great, but the industry is 34.8. And this is kind of a software company. I mean, I think they're feeling the pain there. Price to sales, 9.8 versus 5.6. That's expensive. Price to book value, 7.6 versus 7.7. And price to cash flow, 18.7. Industry at 20.7. Now, the PEG ratio for Microsoft is 1.6 versus 2.0. We do see the earnings over the last year are up 28.8% for Microsoft versus 25.5% for the industry. Sales declined by 16.7% versus 16.6%, about the same as the industry. That's positive. The 5-year earnings per share growth estimate from the analyst, 14.9% for Microsoft, better for the industry at 18.6%. We do see Microsoft pays a 0.9% yield using 21% of their earnings to pay that out. And then looking at the balance sheet here, we got a current ratio of 1.4, better than the industry at 1.8. Debt to equity only 0.2 versus 0.7, so they managed to keep their debt in check there. Net profit margin, extremely good, 39% versus 17.1. Return on equity, and I think they have low equity if I'm not mistaken, but 30.5 versus 30.6. And the free cash flow number, 77.4 billion versus 46 billion for the industry. So they're doing pretty well on that, but I know they're having some troubles, which we'll talk about just a minute here after looking at some other numbers.
Yeah, so current price here for Microsoft, it's $401.14. 52-week range, I talked about the high of $555.45 and the low, $344.79. Year to date, the stock is down a little bit over 17%.
It's not been that long. It's only a month.
A month and a week. Yeah. Going forward, though, this is kind of where the disappointment lies. Even with the big pullback that we've seen going out to June 2027, estimated earnings per share here, $18.87, gives us a target sell price of $313.24. So it is still trading at over 20 times those future earnings.
And I see that the analyst did increase the estimate from $18.51 to $19.04. So that's an increase about 2.8%. But I think that's going to be changing. There's some negative news that I've heard, like I think it was an event that they did, and I believe they had room for 15,000 people and only 5,000 showed up. There's other things that are kind of bruising Microsoft's reputation right now.
Yeah, I mean, the numbers were actually pretty strong for the quarter. When you looked at it, earnings came out at $4.14. The estimate was $3.97. But, I mean, the things that are concerning with Microsoft, and this is kind of a positive negative, right? There is their commercial backlog now stands at $625 billion. Well, that sounds pretty darn good, right?
Yeah.
45% of that is tied to OpenAI. And OpenAI has all of these outstanding commitments. And I could be totally wrong here, but there are now question marks. How the heck is OpenAI going to fulfill all of these commitments when they don't really have that much revenue yet?
Right.
And you have all this competition out there. You know, Anthropic has really been growing in popularity, really been growing in their quality. I mean, we talk about, I hate to say it, but China's AI chatbots and so forth. Can OpenAI fulfill all of these contracts? If not, that is a huge, huge hit to the excitement and the backlog that Microsoft has. We also talk about the capital expenditures. You talked about how good free cash flow is for Microsoft. Is it going to stay that way? When we look at it, the company spent $88 billion on capital expenditures in the last fiscal year. Well, currently they're about halfway through their current fiscal year and have already spent $72 billion on capital expenditures. Wow. So we've seen this huge ramp up, which it hurts free cash flow. And what happens, we've talked about this before, it's not a direct impact on earnings because you're depreciating those capital expenditures. But the problem is you keep spending, you keep spending, you keep spending. All of a sudden, after 3 years, now you have all this backlog and depreciation expense that is going to be hitting the income statement. So they have to see a return. Otherwise, those expenses are going to climb and climb and climb, and it's really going to hurt that earnings growth.
I think another problem I saw when I read about them, I believe the co-pilot said, I think we got, correct me if I'm wrong on the numbers, like 15,000 subscribers.
15 million.
15 million. There we go. That sounds better. 15 million.
15,000 would be terrible.
Yeah, it would be terrible. 15 million subscribers. Sounds like a big number. But I think their total subscribers that they have for their programs and everything else is like, isn't it like over 400 million?
450 million, yeah.
Yeah. So that's not a very good percentage. Should be, you would think. And it's, Copilot's been out for a couple of years, I believe.
I mean, that was kind of, the excitement.
Yeah.
They're really an AI. They have this. And, they still have their, and again, I don't really fully understand it, but obviously their hyperscaling business with the cloud and the data centers and the data servers and so forth. They still are, I guess, a benefactor of AI that way, but the Copilot was really supposed to be this big, exciting thing, and it's been I'm going to call it a lackluster rollout, to say the least.
And from what I've heard, and again, we don't own Microsoft, so we don't follow it. I don't think I've heard anything that is going to change or anything like, we're going to do this to change it. I think they're having a difficulty with that.
I believe so as well, and I don't know. I mean, we've talked about this many times, but it is still just concerning, obviously, all this capital expenditure announcement that continues to happen. I mean, it's great for some businesses, but how sustainable is it? These hyperscalers, when you look at now Meta, Amazon, Google, Microsoft, it's now estimated that they could spend around $660 billion combined this year on CapEx. I mean, I don't know how you continue to do that and how all of them see a big return on investment. Some of them might, one of them might, but all of them, I still don't know how that comes to fruition.
So even the pullback from 550 to like 400, still not a buy.
Yeah, and that's the thing too. Obviously, we sound super negative on Microsoft, right? It's like, oh my gosh, these guys, we hate Microsoft. No, that's not the case. But with a valuation still at 20 times those future earnings, I don't think it's really has that risk adjustment baked in yet. If this thing fell to 12 times earnings, I think I'd be all over it, but it's still not there yet.
Yeah. Well, let's move on to I always wonder about the credit card company. So we thought we'd take a look at Visa because Visa is, I believe they're bigger than MasterCard. I think they're the biggest.
I think so.
Yeah. So, but we're going to take a look at Visa. Their symbol is V, as in Visa. They're in the credit service industry. Short on the flow is only 1.3%, 91% institutional owned. We do see a PE ratio of 31.1. That isn't even above the industry at 26.1. Price of sales 17.5. Wow. 4.8 for the industry. We do see price to book value 16.7 versus 4.8. Price of cash flow 29.6 versus 14.7. I'm just going to say, wow, Visa really trades at very lofty valuations. The PEG ratio does look good, though, 2 versus 4.5. Now, we do see over the last year, their earnings did climb by 7.4%. The industry is only up 4.6. The sales for Visa climbed by 12.5%, industry up 12.7%. And the analysts do give it a 5-year earnings per share growth rate of 12.7%. That's slightly under the industry at 13.9%. Now, they do pay a 0.8% dividend, using 23% of their earnings to pay that out. Taking a look at the balance sheet, you got a current ratio of 1.1. That's below the industry at 1.8, so you'd like to have that higher because it gives you more liquidity. Debt to equity looks good, 0.6 versus 1.5. Net profit margin, 50.2 versus 19.4, and I think that's just because they keep collecting those fees and don't have many expenses to do that, which could be what kills them going forward. Return on equity 53.1 versus 42.7. Free cash flow $23 billion, above the industry at $17.2 billion. Chase, what do you got?
Yeah, so current price here for Visa, $331.58. The 52-week range here, the low $299 and the high $375.51. To answer your question, MasterCard's market cap around $500 billion, Visa's market cap $627 billion, so they are the largest. Year to date, though, the stock is down about 5.5%. Now, going forward, I mean, you kind of already hit on the valuation, so I'm not really surprised to see this number.
Weren't you going to talk on the 5-year return on that?
I was going to come back to that.
Okay, you come back. You keep going.
But the current estimate for earnings per share out to September 2027, it's $14.54. I mean, it gives us a target sell price of $241.36. Still trades around 22, 23 times those future earnings. So it's still expensive. And kind of looking at the returns here, over the last year, Visa is down about 5%. And over the last 5 years, you've done okay on it. Don't get me wrong, right? You're up about 60%. That's pretty good. But the last 10 years, you're up 371%. So most of that 10-year return came within the first 5 years rather than the last 5 years. And I do worry over the next 5 years, you might not see much growth from here either.
And I do worry because now you go to restaurants and, we're going to charge a merchant fee. Well, restaurants, not so much. I think restaurants don't want to do that, but some do, but others don't. Or sometimes, like we're doing something in our backyard, it's a large project with a paving company. No, we don't take credit cards, either Venmo or write a check. I think more people are getting away from using credit cards because either one, they're paid for the fee, the consumer's paying for it, or number two, the company doesn't want to pick it up. So I see the trend of credit cards, unfortunately, declining, which is going to, I think, hurt Visa and MasterCard.
Yeah, I mean, less swipes, less profits.
Yeah. Gosh, I came quick, that closing bell. Thank you for listening to the Smart Investing Show. It is for information purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there, like the newsletter with other topics like the labor market continues to cool, mobile phone screeners, all these important things. smartinvesting2000.com. Thanks for listening. We'll be back next week right here on Smart Investing with Brent and Chase.